Clause 15 says whether your company, your client has entered into any non-cash transaction, like where the money is not involved, with the director or any person who is connected to the director. If yes, then you have to verify as an auditor the requirement of Section 192 of the Companies Act. Simple, the clause is very simple, but we have to understand what is Section 192 of the Companies Act. Right? So the requirement is whether as an auditor, auditor is required to report whether the company has entered into any non-cash transaction with whom, Vishwesh? You're on mute.
Whether the director of the company or any person connected
to him. Simple.
Yeah.
Why this clause has been put, right? Like, what is the essence of it? Like, sometimes companies can actually enter into the transaction where they transfer the land, building, equipments to directors, right? Or they can assets acquired in exchange of shares or other resources of the company with seller, where the seller might be the director or someone else. So instead of paying them, like for example, the company has bought any the company have bought any property, plant and equipment, and instead of issuing the instead of paying the money, they have issued the shares. So you have the companies that acquired asset, and instead of that, they have paid they have paid through shares. To whom? To the wife of director. So this kind of transaction, you have to ensure that this gets reported. The transaction must be approved in general meeting. Which section says this? Section 192 of the Companies Act says this. The transaction should be approved in the general meeting. That member should approve that yes, any non-cash transaction can be done by the director, or if the members are approving, then there is no problem. But the thing is, if Section 192 is not followed, then the transaction without the approval becomes the void, and you have to explain that as an auditor. You have to explain that in clause in CARO clause 50. Easy. Remember the requirement, like the transfer of assets or the asset acquired in exchange of shares. These are the example where the company can enter into a non-cash transaction with the director or any person connected to them. And the Section 192 simply says that if the transaction is done without the approval of members in the general meeting, then there is no, the transaction itself is void. It's not a valid transaction. Make sense? Easy?